Hello, everyone, and welcome to the second part of our session, Taking the Charge Investment Strategies for Women, presented to you in association with Mirae Asset Mutual Fund. During the first part of our session, we discussed how it's essential to provide tips and support for female investors to build their confidence in navigating the world of investments. Furthermore, understanding the key differences in financial needs between women and men is crucial for developing tailored investment strategies. We also learned that women often approach investments with a more risk conscious and careful decision making mindset, further emphasizing the importance of fostering confidence and empowering them to take charge of their financial futures. I'm your host, Anisha Nair Dhawan, and today we will explore the importance of having goal oriented investment approach, financial planning at various life stages, and the importance of regularly reassessing and rebalancing investment strategies for women to succeed in navigating the financial landscape. Joining us again for today's discussions to share valuable insights is Tanya Raghav, Manager Product Development, Mirae Asset Investment Manager. Hi, Tanya, welcome back.
Hi Anisha, thank you for having me.
Tanya, last time also we discussed that goal based investing has become a very popular wealth management approach in recent times. Why is it important for women to have a goal oriented approach towards investments?
So, goal-based investing, this emphasizes on attaining life goals. Now, your life goals could include saving for college, for higher education, saving for starting your own business, saving for building a retirement corpus, so on and so forth. So, all these are a part of goal-based investing. Goal-based investing focuses on life goals rather than obtaining a very high return portfolio. It sort of makes you not chase the wrong thing and makes you chase the right thing. Ultimately, you are earning, you are saving, and you are investing for something, right? That is what goal based investment is. For women, it becomes even more important because your goals keep on changing. You when you are young to when you are relatively in your teens, then you go to your 20s, then when you are in your 30s, goals keep on changing. So with changing goals, it's very important to change your investment process also. Therefore, goal based investing comes into the picture.
Right. Now, how does financial planning differ for women at different stages of life?
Right. So, like I mentioned, financial planning or goal based planning, it all differs at different stages because your risk appetite, your earning, your aspirations are very different at different stages. Also, your duties and responsibilities are very different at different stages. So, let's deep dive more into it. Let's look at the presentation now. So at every stage, there's a different investment approach, there's a different income that you have, there's a different risk profile, and there are different assets that you have to your name. So when you are young, so for the ease of understanding, what we have done is we have divided life stages into like four brackets. The first is that you're the young and free one, you're 20 to 30 years old. The other is the juggling stage, the 30 to 45 years stage. Then is the silver lining stage, the 45 to 60 years. And then is the 60 is the new 16, the 60-year and beyond. So at every life stage, there's different income that you're earning, there's different risk profile that you have, and there are different assets that you have. So just to give our viewers a glance, that when you are young, your income is relatively low. As in when you keep on going up the corporate ladder, your income increases, and then when you're again you are retired, that income level again sees a little different than it was at the previous stage. It sees a little bit on the downside, or it goes back to when you were in your 20s. Maybe you have passive source of income, that main source of income sort of gets away. Then your risk profile also changes at every stage. When you are young and free, you have time ahead of you. You can look at investing into relatively more high risk asset class. As in when your responsibilities and your goal changes, you get into family life, you have children, you have caregiving responsibilities, you start your own thing maybe. Your risk profile keeps on changing. Similarly, your assets also keep on changing at every life stage. So let's understand that how investment strategies for women change at every life stage and what they can do to take charge of it at every life stage. So let's discuss the first stage, the young and free stage, the 20-year to 30-year stage. What are a few challenges in that stage? A few challenges are that, you've just started out, the income is relatively low, you're new to managing money, you want to splurge out also, but you also want to build that corpus also, but you don't know where to start, you don't know how to start. You are still, learning, you're very new to balancing your spending and savings. You're learning how to just have a tight hand at the start of the month, going against your splurging need, or going against your aspiration to splurge. And you're also understanding what your financial goals could be. A lot of things could also come very daunting at this stage, and also a few aspirations could be that, maybe you're looking for a higher education, maybe you're looking for a career change, or pursue, one of your hobbies as your career in the future, or you just want to probably start your own thing. So at this stage, what are a few factors that that all of us could keep in mind? So the first thing is that, one doesn't have, the financial dependency on a woman at this stage is relatively low, and low to no, I would say that, your parents are still probably earning, the financial dependency is relatively low. You're not married yet. You're still young. Age is not a concern. You have time ahead of you. Since there is less age, the risk appetite could be higher at this point in time. You could look at investments, that have relatively higher risk. And you can also look at long term investments at this point in time. This is a good stage to start planning and looking for at long term investments. So what are the potential solutions for this stage? So like I said, the first and foremost challenge, that also stops a lot of women actually from investing, is that, I'm really low on initial funds. Around 18% of women in India do not start investing because they think, okay, let me first accumulate a big amount and only then I'll start investing. But that's not how you can go about things. The first and foremost thing you can do is you can start with the budgeting. You can make a monthly expense sheet. You can understand what are your fixed expense and versus what are your variable expenditures. Your fixed expenses could be your rent, your travel cost. Your variables could be, eating out, dining out, shopping. Then one has to also understand what actually is savings. Savings is what income you have earned minus expenses, whatever is left with you at the end of the month. But then what is investing? When you save with the mindset of, having some growth appreciation on that money, that is what is investing is. So understanding the difference between how saving and investing works. Saving is just keeping the money aside, but investing is putting that money to use for a future. So that is where the this age group, the 20-year to 30-year age group, start. And also start small. Like, you do not need to have a huge corpus to start investing. You can start small. Systematic investment plans or SIP are a great tool that, allow you to invest right from what, 500 rupees, 1000 rupees, 5000 rupees. And you can always increase this amount as and when, your income increases, you enter a different stage, you can always keep on increasing this amount. But this will give you that starting point, that hook point, that, you are looking that, I'm low on initial funds, but how do I go about it? This could be that potential solution of how you could go about it. And also goal based investment, while you are, very new to it, while you're new to juggling a lot of things in the financial realm, you can also see that, okay, what are my essential requirements? Do I want to go for a higher education, or do I want to start saving for my marriage? If, say, I want to go for a higher education, maybe I'll not be able to save the entire corpus of that fees, but I can at least save and invest my monthly expenditure, my monthly pocket money that I would be requiring at that point in time, when I'll be in my higher education, when for those certain years I'll not be earning. So for that, I don't have to be dependent on maybe my parents or someone else for that pocket money, for those monthly expenditures. And at this point in time, it's also good to look at what are my aspirational goals. Do I want to pursue hobbies? What do I want to make out of my career? Do I want to be an entrepreneur? Then probably I can also start looking at that and save accordingly. So this is a good starting point, is that, when one can look at things from a very long term perspective. The second stage, the juggling stage, it's been good 10 years into 5 to 10 years into your corporate journey. A few challenges in this stage could be that, you could be entering into a financial liability. You could be looking at, taking loans. You could be looking at, maybe getting married and, maybe taking a sabbatical for a while, or, getting into primary caregiving for your parents, or, for the kids, or for some family members. Or, you would want to take a sabbatical and understand what you want to do with your career, with your life further. And a few aspirations at this point in time could be that, you would want to purchase that real estate, that you are done with paying rent for the 10 odd years that, you have been working. You want to maybe purchase a vehicle. You want to sort of splurge on your kids. You want to also elevate your standard of living. And, you want to continue your funding of your investments, whether you are actively having that cash flow through a job or not, but you would want to continue funding of that investment. So also few factors that, these 15 years, right from 30 to 45 years, could keep in mind are that, right now there is relatively the financial dependency could be increasing. And, just a second, I'll just pause. This slide is relatively wrong, so will it be fine if I'll give it in the afterwards?
Yes, sure.
Sure, so sorry. Yeah. So right now, a few factors that one can keep in mind, particular people of this age, is that, the financial dependency could see little increase right now. There could be the age you have just entered into an age wherein your risk appetite, right from high, which was in the previous age, could turn into moderate. Therefore, moderate risk appetite could also look at moderate returns. And now one has to invest both from a medium and short term as well as long term perspective. So, to attain certain goals which are aspiration in nature, one may have to save from a short to medium term perspective. For, to maybe to save for kids, or, to save for a startup or something, one can look at long term investment. So bifurcating your investments into short, medium, and long term, this is the stage where you could be looking at that. So, what are a few potential solutions? So, expense projection, making your own personal finance forecast could be a really handy thing to do at this stage. So, what I mean by this expense projection, or your personal finance forecast, is that just note on what are your primary income sources, what are your secondary stream of income, how much income in total you get, what are your expenses, that what are your current expenses, your fixed and variable, and what could be your projected expenses, that is your future expenses. Maybe you are getting into motherhood, so your child vaccines could be one. Maybe you would want to become a caregiver for your parents, so those medical expenses could be one, your future expense. Probably you would want to buy a home, so factoring in that housing loan EMI could be one of those future expenses. So projecting expenses becomes very important, so that you understand what corpus you will be left with after those expenses, and how should you save that remain invest that remaining corpus. So investing as per, like I said, short, medium, and long term financial goals really helps at this point in time. How so? If you have just one corpus, just one kitty, that I have invested say X amount, and from this amount only I'm gonna dig in every time I need. There's a financial need, or there's a goal need. Whenever, if you dig in from that same corpus, you'll be missing out on the power of compounding that it could have. So let me give an example that if suppose in July 1999 one would have just invested rupees 10 lakhs, till February 2024 that could have become somewhere around 1 cr. But even in those 10 lakhs, if you would have redeemed like around 70,000 for a gadget, your investment would have gotten impacted by the tune of say uh, around 10 to 20 lakhs. Your investment amount at the end of 2024 February would be relatively lower than it would have been had you not digging into that same corpus. Similarly, if you keep on redeeming from the same corpus, the amount that you will be left at the end of the investment period, would be much lower, because you'll not be able to take benefit of the power of compounding. So now coming to the silver lining stage, the stage three, that the 45-year to 60-year stage. What are a few challenges that you would be looking at this stage? That you could be now looking at a sabbatical. That this could be the probably the sunset years of your careers. Maybe there are no sunset years, but you could be looking at retirement now. You could earlier you used to save for kids or for their education. Now you would want to save to give them something, to pass them down something. Now your aspirations would be very different. There would be no more that you would want to just you have your own set of assets also. Till this stage you have built on your assets, so your aspirations would be very different. Would be maybe you would want to purchase a second real estate, where maybe you would want to pursue your own hobbies and dreams right now. So, as your financial dependence increase, there is high expenses at this point in time and less savings. Your kids have also, sort of gone out of home. They have started their own lives. They are looking at college. They are looking at higher education. So, not only you have to manage your household with the income and expenses, you have to also manage another household that is of your kids. They may be looking at settling abroad. They may be looking at getting an education in abroad. So you have to also manage those expenses other than their education, how they're going to live over there, how they're going to eat over there, and everything. So this also takes certain uh, hit at your risk appetite. Your risk appetite could now be, while it was moderate or between moderate to high, now it could be between moderate to low, or maybe at low risk appetite. So that is how you start planning accordingly, start investment planning accordingly. So what are a few potential solutions? So greater emphasis on risk profile could actually be a good solution at this point in time, because looking at your portfolio from a view of that, what are my needs and how should I design my portfolio accordingly. What I mean by portfolio is the mix of asset class that you will be having in your portfolio. Suppose you would take, for example, you would want to get retired in another 5 years. So having a relatively higher portion of equity might not work for you, because equity tends to be, whenever one invests in an equity, it's for a relatively higher investment horizon. The longer the investment horizon, the more benefit you reap. So probably you would want to rebalance your portfolio towards, having a relatively higher portion of debt, or maybe a hybrid mutual fund. You would want to rebalance your portfolio as per the risk appetite that you currently have and in the future that you have. And it's also a good time to rebalance your portfolio as per your future needs and your future goals. So coming to the stage four, or the last stage, I would not want to call it the last stage, but in terms of your financial planning or investment planning, the 60 is the new 16. So now 60 years and beyond, what are a few factors to keep in mind? At this stage, you are now reaping your investment. You have been working your whole life. You have invested enough. You have saved enough. Now you'll be reaping your investment. Now you would want to look at probably a liquid fund for your expenses. Your risk appetite would be relatively low, and you would want to consider focusing on short term investments for your short term needs. And a few challenges at this stage would be that you would want to get your children married. You would they would be they could be a that there's no regular stream of income since you're not working anymore. You are banking on the savings and the investments that you have done. There could be an increase in medical expenses. There could also be a loss of partners. And that these could be a certain challenges. Certain aspirations, in these stages could be that you would also wanted to give it back to the society. You want to look at charity. You also would want to continue living the healthy and happy lifestyle that you have managed so far. So with the means that you have, you would want to continue living the lifestyle that you have built so far, you have attained so far, and you would want to go back and dive into those hobbies that you left for your career, for your family in all these 20-25 odd years. So what one can do? One can look at actually a very powerful tool offered by mutual fund investments, that is systematic withdrawal plan, or SWP. How SWP works is that it you have invested certain amount with the mutual fund, and when the time comes that you want certain regular stream of income, you can just access that income through an SWP route, wherein on a monthly basis a fixed amount you can get through withdrawals from the investment that you have made. How it helps it? It helps you to generate a regular income through redeeming your mutual fund investments in part. Not the whole of your corpus gets redeemed, only a part which is required for a month on month basis, that is what gets redeemed. It also gives you the advantage of rupee cost averaging, because still your more than half of the corpus is also still remains, it remains invested. So you also reap benefit out of that, also out of the current investment. And also it is a very tax efficient way to look at withdrawing. You don't have to redeem the entire amount. You just need on a monthly basis, maybe say X amount. So you can only look at redeeming that X amount on a monthly basis. So to sum it all, that how to put money at work at every stage, how to put your money at work to work at every stage. There are certain mutual fund tools, or asset through asset allocation, mutual fund tools, and potential, a mix of mutual funds. You categories you can look at every different stage. So when you are young, 20 to 30 years, since you're low on initial funds, SIPs could be a very handy tool. You can start with look at SIPs and start your investment journey. The asset allocation could be inclined towards equity because you have time ahead, you have a longer time horizon. You can look at in the mutual fund space, probably you can look at equity mutual funds, you could look at thematic or sectoral mutual funds. Since your risk appetite is relatively higher, you can look at a pure equity fund. When you are between 30 years to 45 years, you can look at investing those lump sums. You can also look at topping up your SIPs. What are SIP top ups? That like every year in our income we receive this increment from the company, right? So SIP top up is nothing but increment on your SIP, that you a fixed percentage or a fixed amount every year. You say that, okay, earlier I used to do an SIP of 5,000 per month. From this year onwards, I'm going to do an SIP of 6,000 per month. So, you can always top up your SIP with every stage. And you can also at this stage look at adding a conservative asset class to your portfolio. Maybe, you can now add a hybrid mutual fund, which is a part mix of equity asset class as well as debt asset class. So, as your risk appetite, your risk profile has gone to moderate, you can also look at adding a relatively conservative asset profile to your portfolio mix. Now, when you are at 45 to 60 years old, you can look at rebalancing your portfolio. So systematic transfer plans or STP act as a great tool over there. You have to, you don't have to get into redeeming and reinvesting into another sort of category. You can just use STP of, moving your money from hypothetically maybe an equity asset class to a hybrid or, a debt asset class. So this is also a good time to look at increasing your conservative asset class proportion, and for that you can always look at hybrid mutual funds or debt mutual funds. So for 60 years and beyond, you can look at SWPs for that regular cash flow that you want from your investments. At this point in time, a return of capital is more important than return on capital. So looking at a conservative asset class makes more sense at this point in time. So one can again look at, predominantly debt mutual funds and hybrid mutual funds, which are more inclined towards debt. But at every stage, there's like one rule of thumb that, I would want to say is that, align your financial goals, investment horizon, and risk appetite at every life stage. That is, for how long you want to invest, for what you want to invest, and how much you are okay of let going of that investment. One should be very clear of these three things at every life stage and invest as per that. So tough times don't last, only tough people do. So there are few times that probably maybe you're a single parent, maybe you're a divorcee, or maybe you're a widow. Then how you should approach your investments? Probably the first thing is, you are probably fearful, and take that plunge. Prepare a new budget, prepare things from start from the starting bottoms up. It's also very important for you, or if you have a kid, to have a proper life and health insurance coverage. Explore those options, align your goals and investments as per your short term, medium term, and long term goals. And the risk appetite that you could look at is could be moderate to low, as you are responsible not only for yourself but probably also for your child. So having a relatively low risk appetite doesn't would not harm. And you can also think of alternate source of income. So look out for those government schemes that could additionally help you out. So yeah, and there are also a few pitfalls that one should avoid, that women should avoid while they are planning for their investments. The first is beware of your behavioral biases. Right from the start, even in the previous session, we talked about how women are afraid of just taking that first step, just taking that first step, or just understanding what and why my investments, why I need to do those investments. So get out of those behavioral biases that tell you or pull you down that you cannot do this, you cannot do that. So don't give into it, just take that first plunge. and not taking charge of your finances, or heavily depending on someone else, even though probably you are not the primary breadwinner of the house. But it's always good that to take care of your finances. And how you can go about it is that you can just create a repository of your documents, of your own checklist of to do's, that okay, fine, every month I should be looking at my bank statement. What are my expenses every month? What are my splurges every month? What are the investments I want to make every month? How I want to rebalance it? What are my financial goals? You can also invest some amount of time into reading financial literature, and that would only add into your knowledge more and more. So you can look at aligning your expenses with financial goals at every life stage. Like I said, responsibilities change, financial goals change at each life stages, so your financial planning should also change at each life stage. So at the end, don't be afraid to start. Take that small step in the right direction, as it ends up being the biggest step of your life. Tiptoe if you must, but take that step. So for women, financial independence is a matter of necessity. It's not just, one thing that you should do because it's the right thing to do. It's also a necessity because life is long. You don't know how life is going to turn out for, and that's true for anyone, especially more for women, because from childhood we are taught that okay, fine, there could be someone who will be taking care of you. Don't let that mentality cloud on your judgment, especially when it comes to investment. So yeah, that's how I would want to sort of end this presentation.
Tanya, there are a couple of questions that came to my mind after seeing your presentation. Now, in the last stage or the fourth stage, you said that they think of a SWP, a systematic withdrawal plan. Now, this
Right.
would be dependent on the investments made in mutual funds in your previous years, right? And also the withdrawals done, right?
Right. So how an SWP works is, suppose you have invested X amount in a mutual fund 5 years ago. Now in 5 years it has grown to some amount, and now you want to start on a monthly basis, or maybe on a quarterly basis, or maybe on an yearly basis, some withdrawal from that corpus that you have made. You can start that. So suppose you had invested 10 lakhs, that grew to 15 lakhs in 5 years, and now you want a 10,000 withdrawal every month from the investment that you have made. You can do that. What SWP will do is, it will only redeem the number of units required for that amount. It will not redeem your whole corpus. So your entire corpus stays invested. Only monthly 10,000 worth of your amount gets redeemed. So that helps you in getting that cash flow also out of your investments.
All right. Another thing is, Tana, you said that women initially don't start because they don't have a lot of a corpus to start with. Now, does it make sense to start small but start early, or accumulate till you have a reasonable amount, maybe even later, so that you get more returns on the total sum invested?
I'll say the first thing, it's really important to start small and start early, because you get advantage of time at your side. You get advantage of power of compounding at your side. 500 SIPs, you are just looking at it from a standalone amount of 500. But imagine 500 invested for 5 years, for and getting compounded on those 5 years on a monthly basis, or on a daily basis. That amount would be much bigger than if even if you invest say 5 lakhs after 10 years, because you are letting go of an opportunity cost over here. The compounding benefit that you could have got in those starting those 5 years earlier, that you will not be getting even if you invest in a lump sum corpus. So start small, but start early. It's really important to start.
Right. And Tanya, what are the factors that influence a woman's risk appetite, income, and financial needs also over time?
So, for women particularly, it depends on your responsibilities also. In our society, still women acts as the more responsible gender. So, say if you want, suppose your goal is to go for a higher education, you could be looking at investment maybe 5 years down the line. You could be looking at investments with a relatively high risk appetite. But when you have entered a stage of say motherhood, now you want to start saving for the immediate needs of your child, say paying the school fees or paying the tuition fees. At that point in time, the risk appetite goes a little low because return of capital is predominantly more important than return on capital. You will be okay letting go of that 1 or 2% of upside with a higher risk potential, if it comes with a higher risk. So at every stage, the risk appetite changes. With that change in risk appetite, one should also rebalance their investments.
Right. You spoke about rebalancing, Tanya. You can only rebalance if you're keeping a watch of your investments. How important is that?
So, keeping a watch of your investments is important, but not on a daily basis, on a monthly basis. One should review your portfolio, of course, at an yearly basis. At the start of the year, you can, when at the start of new year, you can always review your portfolio when you're, sitting down that what will be the expenses for the year, potential expenses, what could be your income cash inflows for the year. At that point in time, it's good to review your portfolio, and rebalancing should be done when either you have attained certain goal, that goal has gotten completed, you have redeemed certain amount, or you are investing a new amount. That is when you should look at rebalancing your portfolio, in which should be in line with your future goals at from that point in time. As your goals keep on changing from every life stage, your investment should also keep on changing, should be in sync at least with those goals.
Definitely. Thank you so much, Tanya, for joining us and throwing light on, how women need to assess their investment strategies and make those investments depending on the stage of their life and the goals that they have. Ladies and gentlemen, adopting a goal oriented approach to investments is essential for women as it aligns their financial decisions with their unique life goals and aspirations, ensuring a more purposeful wealth management strategy. Factors such as evolving risk appetite, fluctuating income levels, and shifting financial needs over time significantly influence a woman's financial journey, highlighting the importance of regularly reassessing and rebalancing investment strategies. By understanding and addressing these considerations, women can effectively navigate the dynamic landscape of financial planning and achieve long term financial objectives with confidence. That brings us to the end of the second and final part of this session. Before we sign off, I would like to thank Mirae Asset Mutual Fund for partnering with us for today's session. We'll be back soon with another interesting discussion. Till then, stay well and take care.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.